India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Wednesday morning, which means that, in 12, 14 hours' time, we will have the Fed decision. And we will have that as a big story tomorrow morning. Yesterday was absolutely quiet in the markets. And today, will we be repeating the performance is the question. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Morning.
Hi, folks. Good morning. So it's D-Day, or should we say it's F-Day, right? I don't know what's the right alphabet to go with. But typically, at least what I remember, living memory, the Indian market usually does a bit of a pre-positioning in anticipation of a very expected favorable Fed outcome, right? So I don't know, the bulls have been so quiet now that Ganpati Visarjan is over. Maybe they decide to come back with a flourish and take positions ahead of the event.
They've been chanting Ganpati Bappa Moria yesterday all day, right? So, and I think you're right, because and not just here in India, global markets, it's a very well-priced kind of a rate cut, right? It's a well-expected rate cut, let me put it that way. So quickly, right? The cues as they stand this morning, global markets are in a wait-and-watch mode. The big decision is the Fed decision later today. Fed Chair Powell and his remarks also will be important. Is it 25? Is it 50? I mean, that essentially is the question. If it is 25, will it be followed by enough dovish commentary which kind of projects, faster pace of rate cuts after the first 25 basis point cut? If it's a 50, what is the projection after that? Is it going to be a little slower, wait and watch? I mean, I think, if irrespective of what you get, 25 and 50, both can be, both can stump you depending on what the commentary really is. So I don't think just a 25 or a 50 will... one can decide what the market will do based on that. And I think, irrespective of whether it is 25 or 50, Fed Chair Powell and his remarks should be dovish, should be generally quite dovish. Even if it is 25, they'll make it up for the other 25 in the commentary. So I don't think it's it's kind of hard to see how this can be negative in that sense. Maybe a little bit of profit taking at the very margin, at the very near term, possible. But even that, I mean, we'll see. I think a lot will depend on how he sort of plays it. Now, we were talking about retail sales data, and that came in sort of modestly stronger than expectations. Fed pricing did not move. I mean, one thought that perhaps will pull back a little bit, but that held at about 40 basis points or so. That is today's cut. So market pricing is indicating a 40, 50 basis point cut. Although, I mean, many economists are saying, well, perhaps they will just start with a 25 with a very dovish sounding commentary saying, well, this is just the start and more is coming. Best of both worlds, right? I mean, a strong retail sales number and a 50 basis point cut to kick it off. We'll see. Overnight equities, absolutely flat. S&P actually made a intraday high, all-time high, by the way, but just very briefly, and then it pulled back. So the change, nothing really, flattish close. The 10-year was up 2 basis points. The dollar index is now creeping back to about 101 kind of levels, but it's come off so sharply, so fast, and that's the reason why we're seeing these intraday sort of recoveries. Oil prices, something similar, right? Sharp sell-off, and we're back at near $74 per barrel mark. Just to kind of circle back levels here, they don't change. The target stays the resistance zone, which is the 25,475 to 25,530 levels. We're not very far away. We're very close by, even at yesterday's close. So that's, I think, the broad zone. And we'll see if we get one bout of some pullback profit booking from those levels. We're about 500 points, a little over 100 points away from yesterday's close to the upper end of that resistance zone. Support stands at 25,035. Now, Nifty Bank is sustaining above the 66% retracement of the fall. That also had a very, very flat session. Target here is 52,550, which is the 78.6% retracement. And supports are the 40-hourly, 51,789. And then the 20-day moving average, which comes in at 51,335 kind of level. So, I mean, I said this yesterday morning as well. Maybe, at least on the indices, a bit of wait and watch perhaps is what we are in for. And I think something similar today as well. So 20 points higher on the the indication from the GIFT Nifty. Surabhi.
Okay, so let's see if we can keep building on that and keep drifting higher, which was the case yesterday as well. Just a couple of cues in terms of, we're talking about this probability of 50 basis points or 25 basis points. So here's how the numbers stack up as of now. If you go by the CME Fed Watch tool, then the probability of 50 basis points is a lot higher, and the swing has happened in the last 4 to 5 trading sessions itself. Earlier, it was all about 25 basis points, but now 65% probability of a larger rate cut, 50 bips, and 35% probability of a smaller one, which is 25 bips. Let's, also look at some of the other data points. By the way, the Fed has been on hold since July of 23, and the rate has been the highest in the last 23 years. I mean, just some more stats in terms of where we are and how the cuts will start now coming in from today in all expectation. Moving to some more numbers and data that we're getting out of Asia this morning. We've got the export-import data out of Japan, and it's all below expectations. So the numbers, optically don't look bad. The import number is up 2.3%, but it's a far cry from the estimate, which was in double digits. So weak imports in Japan. Exports are up 5.6%, but again, far lower. The Reuters poll was expecting a 10% growth of Japanese exports. That's not what's happened. So August has been a subdued month. By the way, some of the regional markets are still closed, so just putting that on your radar as well. South Korea and Hong Kong is closed today. Mainland China is coming back to trade. Speaking of export-import data, let's look at the picture back here at home, because we had some big headlines come through. The trade deficit has rushed to a 10-month high. Why has that happened? Because exports have not really moved that much, 34.7 billion versus 34.5 billion, more or less, if you're comparing it year on year. Whereas imports have surged. Imports have moved to above 64 billion now, thanks to all the gold that we Indians are importing. Because of that, the trade deficit number is not looking too great. 10-month high of just under 30 billion now. We'll have, of course, Lata talk more about this data and what the implications could be, but keep that on the radar. In terms of fund flows, we had sort of muted action yesterday, but both institutional investors on the buy side, FIIs and DIIs. FIIs bought just under 500 crores of equity in the cash markets, and DIIs were buyers to the extent of about 870 crores. We'll keep waiting for the big headline, which is the Federal Reserve. In terms of individual stock action, plenty to track. Thanks to the cooling off in oil prices, for instance, windfall tax has been cut. So watch out for some of the upstream oil players. It could be beneficial for them. And very interestingly, by the way, watch out for VST Industries today as well, because Mr. Radhakrishnan Damani, he's been consistently cutting his stake in the company. He sold a little more, and we'll see how that plays out. And whether that weighs on the stock. So enough to perhaps keep us occupied in terms of the individual stock action, and the fact that today is F day. I won't say D day, but it's Fed day today.
Well, that's right. And ahead of that big event, to go light into the event may not be such a bad thing. And in fact, we made this point yesterday as well, that we started gap up, but you could take some money off the table because, there's going to be a big decision coming in from the Fed leader tonight. 25 basis point, well, that could be the preferred outcome. We have seen in the past when 50 basis points comes about, it sets the cat among the pigeons, whether or not the economy is weaker than expected. So 25 basis points is something that I think would be preferable from a bullish standpoint. Today as well, in terms of a domestic cue, you have the Nifty bank that plays out the weekly expiry, so we'll keep an eye out on that index. How are the FIs positioned? 68% of their positions are on the long side, and 32% on the short side. And in the last 1 week or so, you'll take a look at it. The FIs were net long. Will they build on to their net long positions? So the long positioning has gone up by close to around 70,000 contracts, 1.5 lakh contracts to around 2.2 lakh contracts. What about clients? They were net short. Those short positions have gone up by close to around 1 lakh contracts odd. Normally, when we see this sort of a positioning from the client as well as the FIs, it calls for some bit of a maybe near-term pullback, maybe a 200 point, maybe a 1.5% or thereabouts. So let's see how that goes. What are the levels we're looking at? Well, I was looking at the options data. I was looking at the recent reference points as well. And you'll have to say the uptrend is intact till the 20 DMA is held out. However, resistance comes in at around 25,500, 25,550 odd. The Nifty bank, that plays out the weekly expiry, so we'll keep an eye out on that index. And that's the broad range, where you have the 20 as well as the 50 DMA out there. So that's about the broad indices. And as I said earlier, even yesterday I made this point, this market is not for the faint-hearted in the near term. Taking some money off the table, going light into this big event may not be such a bad idea. I'm looking at two clutch of stocks. One is the stocks that have come out of the F&O ban. So we'll keep an eye out on both these two names. And the other one is Nuvoco, one of those cement players that listed and has been a big underperformer. Valuation-wise, it's not cheap, but the market has not been very, very excited about that. Yesterday, we had a large trade. You had a Kotak special fund in there that sold stake, in the company. And before that, we'll just look at it. The stock now is trading above the 340 level, which is a 20, 50, 100, as well as 200 DMA. So technically, as well as trading above those levels. And it appears yesterday, the Kotak special fund, there was a bit of a clean-out trade that took place out there because they had close to around 4.5% stake in the company, and gradually they have been selling stake in the company as well. It was picked up by SBI Mutual Fund, whose consolidated holding now goes up to around 10% or thereabouts. So clean-out trade, cross some technical barriers, and trades at around $85 per ton. We'll keep an eye out on Nuvoco.
Okay, all right, Nigel, got it. So plenty to track today. Thanks for all of those cues. Let's move on then to the equity call of the morning. Neelkant Mishra of Axis Capital says while India's GDP growth forecasts have been upgraded meaningfully over the past few quarters, he does not think trend growth may rise beyond 7 to 7.5%. However, he adds that should be strong enough to push the investment ratio to 34%, 3.6 percentage points above FY24, driven by 1.8 percentage point improvement each for households and corporates. He says the near-term slowdown is driven by unintended fiscal and monetary tightening and thus temporary. He says they're overweight on industrials, where EPS upgrades can continue to justify elevated price-to-earnings multiples. He says EPS upgrades likely in utilities and cement, but metals face some global headwinds.
All right, well, those are some views. Let's get Mark Matthews of Bank Julius Baer and Company joining in with some perspective. Mark, great to have you with us here as always. Thank you very much. Appreciate your time. Is there any condition under which, a Fed cut will be deemed as negative in some way by equity markets? Near term, kind of, maybe pullback, etc. That's another matter. But say from day 2, day 3, is there anything which can go wrong? I'm just sort of inverting the question here, but go on.
Well, we're getting, obviously, a decision on the Fed funds rate tomorrow, but we're also going to be getting the new economic forecasts from the 17 Federal Reserve officials who contribute that on about every 3-month basis. And so it'll be interesting to see if their economic forecasts have changed. And there's the statement that will accompany the decision on interest rates. And of course, last but not least is the press statement and questions and answers that Jerome Powell, the chairman, will make. And so there will be a lot of data coming out and a lot of commentary, and that will be closely parsed. But interest rate cut, if we were going into a very, obvious economic downturn and it was only 25 basis points, then I think you could intuit that as a bad piece of news for the market. But there's no real sign that we're going into a significant economic downturn, I don't think. And last night we had the retail sales, which were, I thought, quite decent. And so on balance, I can't see how it would be a longer term a bad thing to see interest rates come down.
Mm-hmm. Mark, hi, good morning. But on that question, 25 bips or 50 bips, I guess that's what the market is grappling with, right? Let's talk about the scenario of the larger rate cut. And if that is delivered by the Fed, will the markets like it or will they be spooked?
Right now, the futures market is actually pricing in 60 basis points tomorrow. So, of course, it's highly unusual for them to move in that kind of increment. But basically, it's expecting 50. I think there are very few people now calling for 25, given the amount of unofficial signaling that we've had from former Fed officials and articles appearing in the Wall Street Journal and the Financial Times and whatnot. So the 50 basis points is now expected. And if we only get 25, my own take would be the market would be disappointed by that. I also think that, let me just say, we are expecting 25 officially, but we do think that it could easily be 50. And that would not be a policy mistake. We should remember there is no meeting of the FOMC in October. So they have another 60 days to wait before their next meeting in November. So it could be either of them. But my sense is, given that 50 has been so widely factored into prices, there would be some disappointment with 25.
All right. Hi, Mark. Good morning and good to see you in. What about the Indian markets? You've been quite bullish on the Indian markets on the whole. We have trading near fresh all-time highs. Where do you see us headed from here on?
We all know the good stories in India, the strong GDP growth, the good demographics, the EPS growth is good. The market has fared very well since both the general election and the union budget. The problem is that it's just gone up too much. It's up 50% in 2 years. It's expensive. And I really don't think foreigners are going to buy it at these levels. So locals can continue to drive it up, and they may. But I think it's in need of some retracement. And I know I'm not alone in saying that. I think that's a fairly consensual view right now. So I think it needs to consolidate here because it's become too expensive.
No, got that, and I think we'll see what comes, whether that'll happen or not. So far, of course, the local investors have prevented that from happening, right? Any meaningful pullbacks at all. I mean, the crazy story from last night: pagers exploding, in the West Asia. I mean, Mark, Chris would have greed and fear has been saying that for him still, geopolitics is the #1 risk. It's not played out, and he says, well, on both fronts, Ukraine and in the Middle East, he says it's a #1 risk. I don't know. I mean, do you see anything out of this from a market perspective?
Well, since the October 7 attack in Israel, of course, the situation has devolved markedly in the Middle East, but markets have gone up. And if you look back since World War II at major geopolitical events and their impact on the market, then it's clear the ones where there's no economic impact also tend not to see any stock market impact. I mean, the one I tell people, because it's sort of an incredible thing, is when John Kennedy was shot in 1963, absolutely terrible event, assassination of the President of the United States. Well, 12 months later, the stock market was up 25%. There was no economic impact. But then you have other geopolitical events. For example, the Yom Kippur War in 1973, the stock market was down 30% 12 months later because the oil price went up 3 times after that war. So if there's going to be an economic impact from this event in Lebanon, then I suspect you'll see some impact in the stock market. But for now, it appears somewhat remarkably, the situation in the Middle East has been contained. It does not appear to be spiraling. Neither the United States nor Iran want to have a big and direct confrontation with each other.
All right. Well put. Thank you very much, Mark, for joining us and running us through your perspectives on a variety of issues. But of course, we'll touch base once again when we have that Fed decision later today. That's going to be the big sort of macro market driver. We're going to just tease out some of the stocks that we're going to put out with our research team in just a bit. So ONGC, Oil India, Torrent Power, we have Reliance Power, Reliance Infra, SKF India, Mankind Pharma, Suraj Estate Developers, some of the stocks which perhaps open up in the green on the back of news flow. And VST Industries is perhaps the only one that we can spot right now. I'm sure there'll be more, which perhaps on the back of news flow opens in the red. We take a break. We're back. All of that coming up.
Okay, well, the markets that are trading in Asia, they're managing a fair bit of green. The implied open has also been suggesting that we'll sort of keep in tune with that slightly higher trending market that we've had in the last couple of sessions. What about individual stocks? That's what it's all boiling down to, and our team is standing by with the CNBC TV18 list of top stocks to watch. Guys, good morning to all of you. Sonal, let's start first with the good news, perhaps on windfall tax. It's been cut down to zero.
Oh yes, it has been cut down to zero. That's the windfall tax on crude oil petroleum, the production that is from 1,850 rupees per ton to 0 rupees per ton right now. This of course is in the back of significant decline in crude oil prices that we've seen. They were around $92 to $94 per barrel back in July, and they've come down below that $75 per barrel mark, and that's the reason we have seen that cut. Now this is the second instance of windfall taxes getting cut since the time it was introduced back in July 2022. Now do remember, crude oil prices overnight have inched higher, but as long as they remain below that $75 per barrel mark where these companies were making higher realizations, this could continue to be the case as well. But for today, of course, expecting a green tick on ONGC and Oil India on the back of this news.
Thanks a lot for that, Sonal. Well, let's go across to Vivek. He's here to tell us about some more stocks that he's tracking. Hey, Vivek.
Well, good morning. Quite a few stocks on my radar today. Let's start off with Torrent Power. Some positive news flow coming in. The company has received the letter of intent from the Maharashtra Discom. Now, this is very interesting. The company has got the LOI for going ahead and supplying 15 megawatt of pumped hydro storage project capacity. Now, remember, this particular project will be for a period of 40 years. So, one of the longer-term supply agreements that the company has received, and the pumped storage capacity will be from the Raigad district in Maharashtra. The second stock on the radar is Seagull India. Recent listing, company has emerged as the lowest bidder in two NHAI HAM, that is the hybrid annuity model project biddings. Both of these particular projects where the company has emerged as L1 are for the southern, are for the Ayodhya bypass. One is for the southern side and the other one is for the northern side. And the company, the L1 bid for the southern part is at close to 1,300 crore and for the northern part is close to 1,200 crore. Order book at the end of Q1 for the company stood at 9,470 crore. Two stocks from the ADAG group also in focus today. Reliance Power, the company says that all obligations that the company had as guarantor on behalf of Vidarbha Industries Power now stand extinguished and settled. So the company, earlier which had claims of close to 3,872 crore are now done with, and the company says that the listed entity has zero debt. Reliance Infra, again, the company has reached a one-time settlement with a creditor, which is Edelweiss ARC. So all NCDs, that the company had earlier claims on, worth almost 385 crore, now stand settled. So again, some positive news flow for Reliance Power as well.
All right, Vivek, thank you very much for that. Well, let's talk about two other names, SKF India and Mankind Pharma. Vinny's got details. Vinny, good morning.
Good morning. So we'll start with SKF India, talking about this one, the parent company AB SKF. Now they are going to be actually separating their global automotive business, and they plan to list this automotive business in the Nasdaq by mid-2026. Is that strategy going to play out in SKF India as well? That's important to watch out for. But this is mainly a strategic shift by the parent company, and possibly right now SKF India's committee, they're going to be setting up a committee to discuss similar trends may be possible in India. So keeping an eye on that. Moving on, we have Mankind Pharma, that's in focus. Now the company is going to be meeting on 20th of September 2024. That's to discuss fundraising plans. Do remember that the company has actually acquired BSV, that is Bharat Serum and Vaccines Limited recently. That's around a 13,600 crore acquisition. And this is mainly to fund this acquisition. They've spoken about this before as well. So they will be raising some debt equity as well as through internal accruals is what they will be paying for this acquisition. And this fundraising is on the back of that. So keeping an eye on Mankind Pharma.
Okay, all right, got it, Vinny. Thank you very much for that. Let's go back to Vivek, who's watching out for some more stocks, including, I think, VST Industries and Suraj Estates. What's the news here, Vivek?
Well, both of these companies yesterday had significant large trades take place, in the stocks. So the first one is VST Industries. Once again, Radhakishan Damani, noted investor in this particular company, again has gone ahead and trimmed his stake by a further 1 lakh shares, almost, amounting 0.65% stake. This particular stake sale was done at 439 rupees a share. Remember, July 24th, earlier this year, he sold close to 2.26%. At the end of Q1, RKD and the associated entities held close to 35% stake in the company. Suraj Estates yesterday, positive development movement there. LIC Mutual Fund, the Flexi Cap Fund, picked up almost 2.83 lakh shares in the company at close to 758 rupees a share. So some positive news coming in as far as Suraj Estates is concerned.
Okay, got it, Vivek. Thank you very much for that. So let's quickly recap our list of top stocks to watch today. The ones that have positive news flow around them are ONGC, Oil India, Torrent Power, Segal India, Reliance Power, Reliance Infra, SKF India, Mankind Pharma and Suraj Estate Developers. VST Industries is the only stock on the radar on the back of potential negative news flow. All right, that's the stock list for the morning. Let's now move on to commodities. We have Manisha Gupta joining in with a roundup of all the action. Manisha, it's the big day, the Fed day today, and interestingly, the dollar strengthened a little bit today. What's the action like?
Oh, well, absolutely. But the latest data also shows that there is now a 69% chance of a 50 basis point rate cut. So that is what the markets are working with. A 25 basis point would lead you to some profit taking. And that's what the jitteriness is all about. But when you look at the crude oil prices, apart from the U.S. Fed, it also is about nearly 12% of Gulf of Mexico crude output offline. The renewed tensions in Middle East with the pagers detonating across Lebanon also has added premium, and the supply disruptions in Libya also seem to be supporting prices. The gold prices, in the meanwhile, are trading at a record highs right now. We also have seen buying continuing in case of ETFs, and that has led to the prices on the higher side. In case of metals, it is about strength here as well. With the weak China data, there are expectations of stimulus measures coming in. So you have copper prices trading at a 2-month high, zinc, aluminum also trading at a multi-week highs in the Asian markets.
Manisha, thank you very much for that. So that is a bit on commodities in focus this morning. We'll take a quick commercial break here. We're going to come back and Devin Choksi will be with us with some fundamental stock talk. That's coming up. Stay with us.
Welcome back. Here with us on Bazaar Morning Call, and let's get to our first corporate conversation on the show today. We're focusing on the auto ancillary space. BMW earlier this month announced a guidance cut for the current year FY24 due to sluggish demand in some of its key markets like China. And BMW is not the only one. A lot of other global OEMs have been downsizing their forecasts for the year. So how can this sort of a guidance cut from these majors impact Indian OEMs and, of course, Indian auto ancillary companies? To talk about this, we have with us K. Ajit Kumar Rai, founder and chairman at Suprajit Engineering. Mr. Rai, great to have you on. So the headlines coming out of some of these major companies, I mean, it's BMW, but it's also been Volkswagen, I think Porsche. Quite a few of these OEMs have all been pointing to the same thing, which is sluggish end demand. Now, you tell us, first of all, what is Suprajit's exposure to some of these global majors, because you do have a sizable, export presence as well. So what is your exposure, and will this impact your own forecast for the year?
Good morning, and thank you for having me on your channel. I think what you just mentioned about some of the, shrinking of volumes of Volkswagen, BMW in the public space is very valid. We have been, of course, big suppliers to some of these names. Globally, automotive is not growing. Actually, it's probably degrowing as we speak. The demand situation is pretty poor. Still, the offtake of the vehicles by all these regions, particularly in North America, in Europe, has been pretty poor. China has been, compared to the past, has not been exciting. They're also probably in a low single-digit numbers. So if you look at Suprajit, I think, 50% of our business is domestic focused and 50% to some of these major customers of ours. And what has been good for us has been that we have been winning a lot more contracts than our competition. So if you look at the overall picture, despite there is no growth or a negative growth in the global automotive market, we have been growing reasonably well, thanks largely due to some of the new contracts that we have been winning with some of these marquee names that you mentioned.
Sir, for the full year, however, I mean, in the earlier part of the year, I think the indication was that Suprajit could definitely do double-digit growth. will you have to scale down those expectations now? What's the full year growth estimate you have at this point?
See, what we have said in our business forecast, in the first quarter or end of last year as a, guideline for this year is that we will, as a consolidated group, we will grow in double digits. We are still holding on to that guidance, again, thanks to largely some of these new contracts. In the first quarter, we had, I think, 8.5%, 9% growth. And I do expect that with the strong domestic market as well helping us, on an overall picture by end of the year, we still are hopeful of doing a double-digit growth, despite the global outside of India markets being pretty poor.
Okay, all right. Good morning, Mr. Rai. So on the top line, we'll see a double-digit growth with margins in the vicinity of 12-13%?
Yeah, I think we have sort of said that we should be aiming at around 12%. That's where we are currently on a consolidated basis. And we hope to maintain that and, let's see how the year goes. As we said, if the growth has been robust, it's much easier to improve the margin. When the growth is a little tempered, then I think it becomes a challenge. But I think 12% is what we have guided, yes.
Okay, all right. Mr. Rai, I wanted to focus on the largest part of your business, which is Suprajit Controls division. That's around, I think, 47% of your total mix. And you've done well over there in terms of improving the margins. When do we see margins for this division go to double digits? Point number one. And point number two is, what kind of growth are you factoring in for this division, since it's the largest part of your mix?
Good points. I think in terms of the margins, I would like to give a general background how the global auto component businesses are run. Typically, global auto component run, most of them are between 6 to 10%. So we have taken our first target at the mid-range at 8%. I think that's where we are now. The aim is to go to 10%, but I think it will take much longer period, at least a year or two, because global markets are very competitive and the cost structures are different, unlike India. So I think it's going to take, we are at the midpoint, which is, I would say, reasonable as far as we are concerned. In terms of the growth for the controls division, we had about 3-4% growth in the first quarter. We are still hopeful that by end of the year, as just now we discussed about how the global automotive business is, which is either at a flat or negative growth. The fact that we'll be able to, even if you're able to do 7-8%, which I think would be very good for us, and a consolidated base will certainly do double digits.
Okay. Mr. Rai, hi, good morning. Could you tell us, beyond FY25, right, you said you should do at least 10%. Does the environment that you're describing, does it dim the outlook for what you'll be able to do in 26 as well? Because if I look at some brokerage notes, for 26, growth assumption was a little higher, 17 to 20%. Will that need to be pulled back?
I think we're always optimistic in the futuristic numbers, I guess. But having said that, I don't know which brokerage report and whether it's for an India market or a global market, but global market will be. That's
a full consolidated full year FY26 growth for Suprajit. That was the expectation.
Is it? Okay. We don't really give a futuristic number like that. I mean, if the brokerages they've done their own homework. But for us, I think this year a double-digit growth and next year hopefully slightly better is what we would expect. Simply because that we have won certain significantly large businesses. They will all get into production in the next financial year. So that's probably the reasoning behind those comments by the brokerages.
The acquisitions you've made, etc., all of that will...
yes, all of them put together, yes, of course. Then certainly, that number can be met because we just, did an acquisition that will also add to the top line. So with all that, yes, I think that is possible. Yeah.
So Mr. Rai, on the auto side, Mr. Rai, when the slowdown that you're describing, is it very recent or has it been, we've been in this environment for a while?
And if I could just add to Prashant's question, so if I could just add to Prashant's question, this global slowdown, do you see it ebbing anytime soon? And is it because of the flood of Chinese EV cars? There's the huge flood in the US and then in Europe, and now we have tariffs going up. So is it because of that, or is it some other structural nature, and will it, continue to last?
I think what is happening globally is that, post-COVID, there has been a surge for a year or so. And then again, with the interest rates going up, the first challenge for any family is to have a home or whatever urgent things. A car purchase can be postponed by a year, 2, 3, if needed. I think that's what is happening. The current interest regime is so stiff, and we all know that the interest costs are so high. The families cannot afford to have an EMI which is not possible to meet from the salaries and things like that. So I think that has been the challenge in the global market. But with the interest rates coming down in US as we see, and Europe is also talking about it, I think the situation will change over a year's time. And when the tide turns, I think it will turn very positively. But I think we are probably a year or two ahead of it. We need to see the effect of lower interest rates really, sort of going to the grassroots level. So I think that's going to take some time. For us, I think it won't matter that much because of, what's happening in our business is that the smaller competitors are losing out, and the stronger and value suppliers like us are gaining traction. And there is a consolidation happening, and that we are the beneficiaries of it. So that is what is helping us in terms of the growth and the margin profile that I talked about. Automotive industry per se is in a tough wicket, at least for another year, as I see it in the global market.
Got it. Mr. Rai, final question before we let you go. You've given us a fair bit of color on the largest part of your business, and how do you see the globes play out as well? But you briefly mentioned about that inorganic growth. You did that acquisition, I think SCS, which has a revenue of around 450 crores, but it was EBITDA negative last year. Could you tell us what is the turnaround plan? Does it turn EBITDA positive, say in FY26? And how do you see the revenue scale up from around 450 crores?
It's about a 40 plus million euro business that we have acquired. Part of it has been concluded. We just completed the Poland, Germany, and the Morocco side of the transaction, and the China and the Canada side of the transaction set to be done. So that will add to the top line. Yes, it was an insolvent company. And so obviously the EBITDA margins were negative because of the various expansions they were doing at various places and not being able to conclude successfully. I think what has happened now is that we are going to be having two major plants, one in Morocco and one in China. And then the rest of them will all be basically support systems. So the whole cost structure will change. But to execute this, it will take at least, I would say, a year or two. We got a good value buy, but we need. I think we'll have at least 18 months work to set everything in place, and then probably make it a decent asset for us.
So by FY26, it could turn EBITDA positive, this new acquisition, by the end of FY26?
Yeah, let's hope so. I think that is possible.
Okay. Appreciate you joining in, Mr. Rai. Thanks a lot for joining in and giving us all of those details.
Okay, all right. That is the word from Suprajit Engineering. We have Deven Choksi joining us on the show this morning. Deven, hi. Great to have you on. I don't know if you could listen into that conversation, and I want to sort of ask a broader question on autos and auto ancillaries, because if we go by the commentary we just got from the Suprajit management, this slowdown is here to stay, at least for a bit, at least for another couple of quarters. Do you like anything in the auto ancillary space at this point in time, or even OEMs?
Yes, Sylvie, good morning. Couple of, I think, points here. The European pack and particularly in Europe, I think the slowdown is very, very pertinent. But if you look at, I think, the other than Europe, I think the slowdown is not looking as threatening. China may be having some near-term issues, but I think it's not something which is to write off completely. In my viewpoint, I think though OEMs might show some kind of, in particular in passenger vehicle segment, in motor car segment, I think they may show some amount of, I think, reluctance or the slowdown, I think, that they are talking about. But it's not likely to see the permanent impact. Second thing, structurally, few things are changing. On one side, I think we are seeing the crude oil prices coming down. As a result of which, I think the metal commodity prices coming down. As a result of which, I think ICX engine, I think, is basically, once again, I think, getting a little better shape than before. So that part continues. For auto ancillary, on one side, I think they may have slightly tapered demand, but at the same time, they are margin protected because of the commodity prices coming down. So all in all put together, it's not likely to be, I think, that bad picture. In my viewpoint, I think the one thing which stands out very clearly out here in India market particularly is commercial vehicle, and second one is two-wheelers. Both of them are basically showing distinct signs of growth. Commercial vehicle largely because of the B2B consumption in the country is increasing due to infrastructure spend, due to industry spending, and two-wheeler largely because of the rural India getting higher amount of disposable surplus in hands of consumers. So I think these two space in the auto, they remain relatively safe. And any ancillary, I think, catering to them in a systematic manner, probably I think we'll have relatively better time going forward. So the likes of Tata Motors, likes of Ashok Leyland on the OEM side, they remain favorite. Two-wheelers have actually by and large moved up, including Bajaj, though it continues to remain favorite within the portfolio. And within the OEMs, auto ancillary space rather, the two Mindas, Minda, Minda and Minda Corp, both of them remain relatively, I think, more convincing play for us in the portfolios.
No, got that. By the way, the one which was up, actually yesterday autos had a very good day. Bajaj, Hero and Mahindra were the top three nifty gainers in trade. And of course, you had the Ola Electric stock, which was up 10%. So, yeah, I mean, it was a good day for autos as a space. I mean, it's been a great run, but they had consolidated recently. Bajaj Housing is the other one. Was up 10% yesterday. There was a note from Phillip Capital. Devin, your sort of note yesterday that Bajaj Housing's market cap is greater than the next 10 players. Just briefly put that into context for us. I'm assuming if you look at AUM, Bajaj Housing is at about 1 lakh crore. The others are combined. I don't know how much if you've looked at the numbers.
Yeah, Prashant, good morning. Well, you are right. I think we put across this particular note that I think against other 10 companies in the housing finance business, Bajaj Housing Finance, I think, is about 1 lakh crore kind of AUM. And rest of them may be struggling around that level only, I think, all put together. Maybe slightly more because of LIC Housing Finance. But overall, I think the AUM numbers, I think, are remaining largely skewed. And probably, I think the valuation is largely skewed in favor of Bajaj Housing Finance. Whole point here is, I think, why Bajaj Housing Finance. I think the revenue mix which comes out from, on one side, you have a mortgage portfolio, affordable and prime housing. On the other side, you have got loan against property, discounting of the rentals, the developer finance. All this portfolio of mix, I think the revenue is giving them an advantage. At the same time, this company is a very peculiar habit. Whenever they quote at a higher valuation, like currently they're quoting it around 7 times price to book value, I think they come in the market, they raise the money, and they use equity money largely for the purpose of, I think, lending. Because on equity money, suppose on 180 rupee price, I think 10 rupees is a serviceable equity. Rest of them is, I think, is a non-serviceable equity as far as I think it goes into the books of the company. So they take the distinct advantage out of it, and as a result of it, the NIM always remains higher compared to majority of the players who end up generating 2% NIM. Really, this company is generating or promising to generate further higher NIM of around 6 to 7%. So in my viewpoint, this is the advantage that this company is getting. But more importantly, for Bajaj Housing, I think every 10 rupee added into the stock price, it gives 7,500 crore worth of increase in the market capitalization for Bajaj Finance. I think that is more important to understand this subject.
Absolutely. Well put, Devin. Just coming back to you for more, Anuj is here with what he's watching as far as this trade setup is concerned. Anuj, good morning.
Morning, Prashant. Well, of course, all the markets are in wait and watch mode, and that's what the Gift Nifty is also telling you. And for good reason. We have perhaps the biggest macro event of the year lined up, perhaps the biggest macro event of the last 3 years lined up, the Fed outcome, and the debate is on 25 or 50 basis point rate cut. The probability of the 50 basis point rate cut has gone up. In fact, I'm told it's now even higher than 64%. The US retail sales was slightly stronger than estimate. I don't know if the Fed would consider that data point. But anyway, that's another data point to look at. Now, my personal view is that if there's a 25 basis point rate cut, that would be initially perhaps a bit negative for the market, sentiment-wise. But after that, it could be, a precursor for a rally, because that would mean the best case outcome. The economy is also resilient and the Fed is also cutting rates. A 50 basis point rate cut, on the other hand, might lead to some initial uptake, but after that the market could make a hard top, because that would mean that the Fed is getting into a bit of a panic mode. So let's see what happens. And if there's a 50 basis point rate cut, my sense is the big rally could get sold into. In terms of market levels to watch on the Nifty, the first resistance I'm watching out for is 25,445 to 25,516, the all-time high in the option zone. And then the bigger resistance is 25,558 to 25,650. The support comes in at 25,350 to 25,400, yesterday's low, and then 25,250 to 25,300. In terms of bank, the trade for today, though, is to just sit and enjoy and perhaps wait for what happens tomorrow. The bank Nifty is one shade stronger than the Nifty, and of course, it's a weekly expiry today. The option writers range here is 51,900 to 52,400. Why do I say that? Because normally on Wednesdays, markets spend the time in that range of option writers. Wednesdays normally belong to option writers in our market. That's the setup for the day, and I'll come to the quote of the day then. It's on trading, actually. The goal of a successful trader is to make the best of trades. Money is secondary, and that's why I believe that if you're a trader, perhaps process over outcome, you want to go home with some kind of neutral positions and take a fresh view tomorrow.
Okay, fair enough, Anuj. And yeah, that point is really well taken, that if you get that 50 basis points, maybe initially, yes, it's in sync with the probability, but what does it actually signal that the Fed moves straight away to 50 basis points after being on pause for over a year? So let's see, this is going to be a very, very interesting one. Just wondering, Prashant, staying up tonight for this one? What about Nigel? I wonder who's staying up.
I think for Nigel it is hot water and sunglasses and goggles through the course of the day. So, but I think we'll all wake up, early enough, right, to be still counted as not 9, but
I think it's going to be a fairly volatile commentary, the cut and all. So
I'll join you guys back on Monday. Because I'm on leave from tomorrow.
So he's going to watch from the sidelines and see how the market reacts. So that's true.
But I think 25 basis points will be better from a longer term view, and going light into the event could be favorable. So let's see how this goes.
I was Mark also made that point earlier. I was saying this yesterday or the day before, that, 1 week ago, 25, I was also saying that 50 perhaps, does the Fed know something we don't know?
Yeah.
That's essentially, is a panic kind of a cut.
Right. Yeah.
But I think they've telegraphed this very nicely through that Wall Street Journal article. I refuse to believe that these are it's a pure nice coincidence that, 3 days before, and the Fed is in a blackout period, and there are these articles, and the person who writes those WSJ columns is known as the Fed Whisperer.
Yeah.
Right? And those articles come, and 50 is on the table.
They've primed the market.
They've primed the market.
Yeah.
And some have said, well, it perhaps is the market trying to hustle the Fed to giving them a 50. I think it's flipped a little bit. 25 would have been the consensus, and 50 would have been maybe, well, what's happening?
But now the consensus
is 50.
But,
So my point is, I think there's too much focus on 25 versus 50. If you look at history, a month later, 3 months later, 6 months later, 12 months later, markets are higher. I mean, that's essentially the point. So, it's very, very near term in terms of what happens just overnight.
Let's just hope whatever happens after 12 months when the Fed starts a rate cutting cycle. In the past, we've seen a lot of major crises play out. Let's hope that's not what we're getting to. And this time it indeed will be different. Okay, on that note, let's take a quick break. We'll come back on the other side and get you the technical setup with the experts. Mitesh Thakkar and Sudarshan Sukhani will join in with some trading ideas.
Okay, welcome back. There's 8 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they'd want you to do as we begin another session. Gentlemen, good morning. Good to have both of you here. Mitesh, so it's sort of, what's the trade first up, right? When yesterday was flat, Bank Nifty was absolutely flat. So another quiet day today. And how would you want to go in? Light?
Morning, Prashant. I think, it will be another quiet day for two reasons. While we have the expiry today, so that always comes into play towards the last 1 hour. But barring that, I think the rest of the markets can be slightly quiet and consolidated because a lot of hourly indicators are now turning flat and sideways. So in that sense, I think, the market could just consolidate. The Bank Nifty, if it starts getting past 52,350 yesterday's high, then we might see some action. Otherwise, it will be a quiet day.
Okay. Sudarshan, hi, good morning. How are you reading the picture, and any trades ahead of the big outcome?
Yeah, good morning. See, the picture is very simple. The market is consolidating. We are in a strong uptrend. Last week, we saw what happens once the consolidation ends. We saw a stupendous move on the upside. I don't mean that this is going to happen again, but that is the most likely scenario. Till the markets don't give signs of reversal, consolidations should be assumed to be just part of the process by which they will take another step up. Now, the big news is unknown, so I cannot anticipate what the markets will do here in the US and India, but I would still be a buyer. So the trade is to buy call options and carry them overnight. The worst that will happen is that the call options will expire worthless. And that's the risk. That's always a trading risk. And today, assuming the markets are quiet and they go into a small dip, or even without a dip, if they consolidate, go and buy.
Okay, all right. So stay long. That's the advice. Let's come to stocks as well, gentlemen. Mitesh, which are the individual names you'll go with today?
Yeah. So I have a buy on Escort. After a good correction and underperforming the rest of the auto pack, Escort is now showing first signs of reversal. Keep a stop at 38.30. Look for targets of 4,000. Havells is a buy with a stop at 1984 for targets of 2050. Also buy on Hero Motors, which is seeing good continuation. So I would recommend a slightly deeper stop at 5,900 and a position target of 6,100. And a buy on Bosch with a stop at 34,100 for targets of 36,000.
All right, got that, Mitesh. Thanks for the list. Sudarshan, what about your stock trades today?
Well, a lot of mid-cap buying opportunities. Exide is a buy with a stop under 475. Siemens, which is a buy on dips, and it's an excellent positional trade too. We want a dip, and this stock is giving us a dip. Buy with a stop under 6,700. Motherson is a buy with a stop under 190. And Mahanagar Gas, another intraday and swing trade, is a buying opportunity with a stop under 1860. So it's an all buy list.
All right, got that. Gentlemen, thanks very much. We'll come back to you with some more questions and more ideas a little later. Right now, take a quick break. Come back on the other side. We'll, of course, have the pre-opening rates. And also, we put the spotlight on the real estate sector. Numbers continue to look fairly good, whether it's demand or new house registrations. Parvez Akhtar Kazi, ED at Nuvama, will join in with some thoughts and how to play the space.
Welcome back. We've got the market, which is getting closer to the pre-open session, just about, 2 minutes away. Let's get you some F&O trading ideas as well. And we have Rajesh Palvia with Axis Securities joining us now. Rajesh, good morning. Good to have you with us here. I think Sudarshan was also alluding to maybe playing it via the options market over the next 24, 48 hours or so because of the Fed decision and maybe the volatility around it. How would you trade it?
Good morning, Prashant. Yeah, so volatility is likely to be there, but looking at the data setup, Nifty is confidently holding above 25,300 put-based concentration. We have seen a dip in last 2-3 trading session, but again and again, Nifty has taken the support from that put-based concentration. So I think 25,300 may act as a good support for next couple of days. If it's hold, I think there is a possibility of short covering action to trigger in the market. As Nifty has briefly crossed this 25,400 level, but still short covering is still absent. But I think if we continues to trade about 25,400, I think there would be some short covering action we can see in the market ahead of this event. And if that happens, possibly Nifty may scale up to the level of 25,500, 550 zone. That's the major call concentration area for this weekly option expiry. To play this up move, I think one should focus on 25,400 call option, which was closed at around 107. So I think 107 to 100 is the range where one can buy with stop loss of 68 and possible target for this call option we could see towards 165 to 170 next 1 or 2 trading session. So I think that call option is looking attractive to play this up move of market. Bank Nifty is comfortably holding above 52,000 level. So put-based concentration is still intact for the Bank Nifty, and some of the private banks are also, participating in this rally. So we believe that, Bank Nifty continues to hold above 52,000. I think possible rally can extend to 52,600 to 52,700 kind of zone. So at this juncture, our stop losses are placed at 51,800 to hold long position in Bank Nifty also. On the stocks front, Bharti Airtel is looking promising. The way stock is moving in higher top, higher bottom formation, I think Bharti Airtel can be looked at to buy for upside target of 1730 to 1740. Stop loss can be placed at 1630. Second stock is from banking sector, that is ICICI Bank. Almost stock is now trading near to its all-time high trajectory. We believe that, upward momentum may continue further. 1300 to 1320 would be the next target. Your stop loss should be placed at 1240. And the third stock is L&T. A very strong buying action in last two trading session. We believe that, L&T may extend its gain. 3760 is the next target. Keep your stop loss at 3645.
All right, we take that point. So those are the FNO trades, possibility of an up move in the next couple of trading sessions. He suggests one goes, plays this via buying the options. The Nifty call at 25,400. There has been a fair amount of punt buying at the 25,600, 25,700 and even 26,000 calls for a pop of almost 1 to 2 rupees. Maybe the street hopes that, there could be an encore of what happened last Thursday. Not always is that case. We have some pre-open rates coming by right now. We'll wait for them to settle. Even though they are settling, they aren't doing much, just the way the market has been consolidating ahead of the big Fed event. Day before yesterday, the trading range on the Nifty was about 110 points. Yesterday, that narrowed further to about 90 points itself. Let's talk about the realty space now. Realty stocks have been buzzing in trade, not just this week, but earlier as well. But this week itself, in an otherwise consolidating market, the realty index has been up around 1.5%. Mumbai property registrations also picked up in August. Parvez Akhtar Khazi, who's the ED at Nuvama Group, joins in to discuss their call on the sector. Parvez, there could have been some sort of pre-buying ahead of the Shraddh period as well. That explains the kind of registration uptick that we've seen. What's your sense? There's 15-day cool-off period, and thereafter, ahead of festive season, there would be bookings once again?
Hi, good morning. So yeah, for most of the real estate space, now we are coming towards the festive season and we will see launches picking up from most companies. So the expectation of those launches doing well is one of the reasons why the stocks have started doing well recently. Another reason, obviously, is the expected cut in interest rate. Interest rate, obviously, purely from a sentimental point of view, is an important parameter for real estate buying. And therefore, any cut in interest rate in US and then ultimately in India is also one of the reasons why these stocks have started doing well recently.
Although, Parvez, hi, morning, Prashant here. The first cut in India by the RBI perhaps only will come through in December. That's the broad expectation. But point taken. I have two questions, Parvez. Stocks have done phenomenally well. And depending on who you ask, you get time frames of how long this upcycle in real estate will last. But as a stock investor, do you now get to a point where you start to look at maybe this is like a late cycle phase where you need to be careful of what you get exposure to, maybe start to book a little bit of profits here, or you think it's got a long way to run? I'm talking from a real estate stock investor point of view. And of course, second is, I don't know if you have thoughts on Century Textiles. Again, it's done very well. Small player, but has, of course, grown quite rapidly, bought a large land parcel here in Mumbai. So a view on that as well. Go on.
Sure. So from a stock market point of view for real estate stocks, our thought process is the valuation re-rating is largely over. Whatever had to happen fundamentally in terms of demand being strong, unsold inventory getting corrected, prices increasing, leverage levels going down, free cash flow improving, all that is either already done or already factored into the prices. So purely from a valuation point of view, for most real estate stocks, the story is over. However, at least for next 3 to 4 years, we are still very bullish on the demand front, and which would mean that pre-sales and ultimately the earnings growth will continue. So the way we look at the sector is for next 3 to 4 years, while multiple re-rating story is already over, you still have a very strong earning growth story which will play out over the next couple of years. Plus, time to time, as I said, any cut in the interest rates would definitely give a little boost to your valuation. So we still remain positive on real estate stocks for the next 3 to 4 years. Talking about Century Textiles, while we don't cover the stock, the company has done well over the last few years. Recently, their business development has been very strong. Like most other organized developers, the Birla Group is also increasing their focus on real estate due to the industry consolidation and customer preference towards recognizable brands. And that is why we feel this company as a whole should also do well. But as I said, we don't cover the stock, so I won't really be able to talk about the valuation part.
Yeah, and soon Parvez will be talking about Raymond Realty as well, right? Because that's also going to be demerged. They have a sizable land bank. But I think we'll wait a while till we get the official numbers, and then we can start talking about Raymond's Realty business. But a lot of the South-based players, the trend in the last 1 to 2 years has been they've all made inroads into outer markets. So, they're going into NCR. Even Puravankara announced this big foray, I think, somewhere in South Mumbai in Breach Candy. They're getting into all kinds of markets, including which were highly prize markets like Mumbai or NCR. What have you made of this development? And again, I go back to that valuation question. While you're positive on the stocks, where do you have the valuation comfort? If you could name your favorites.
Sure. So to answer your first question, South-based players coming into Mumbai is a natural progression. When we look at the industry consolidation part, while historically real estate used to be a localized sector, now we have reached a point that in particular home markets, the top players already have achieved a market share of anywhere between 10 to 15%. Beyond that, frankly, it is difficult to grow in their home market. And therefore, if you have to sustain your growth, you have to diversify into other markets. Godrej was the one who led this whole story a couple of years back. Now we are obviously looking at the South-based players coming into Mumbai and NCR. Even otherwise, I mean, look, DLF will enter the Mumbai market this year. You have Mumbai-based players like Lodha who have gone to Pune and Bangalore. So I think this story will continue of companies diversifying away from their home markets. Because as I said, market share in the home market has already kind of peaked out. So if you have to sustain your growth, the only way is to increase your target market by entering new cities.
Fair enough. So then let's talk stocks valuation. What should be a comfort zone? Because like we've been discussing, many of these stocks are already up 200%, 300% in some cases in just the last 1 year.
So purely from a valuation point of view, most of these stocks are trading anywhere between 30 to 50% higher than their NAV, or you could say a premium to NAV. These valuations are, you could say, close to the lifetime high, but these are also supported by the fact that industry was never consolidated earlier the way it is today. Also, for the first time, these companies are generating free cash flow. Earlier, pre-sales growth was inevitably followed by increase in debt. This time round, while debt levels are at an all-time low, pre-sales growth is at an all-time high. So yeah, I mean, valuations are expensive, but there is a reason, and there's a fundamental reason why those valuations can be justified. As I said earlier, any further chances of re-rating, the answer probably is no. Therefore, we have to just play the earning growth story. With respect to valuations across sectors, as I said, most stocks are trading anywhere between 35 to 50% NAV.
Parvez,
not. Yeah.
Right, we're running out of time. So quickly, if you could tell us, if someone had to put an incremental 100 rupees into the real estate sector, how should they, diversify that 100 rupee, and what stocks, in what order, in what proportion would you recommend they do this?
So we continue to prefer the Bangalore-based players like Prestige, Sobha, and Brigade. So out of your 100 rupees, I'll probably put 70 odd rupees in the Bangalore-based players, and the balance 30, you could say, maybe equally split between Mumbai and NCR-based players.
Bangalore-based players implying Sobha, Prestige, and Puravankara.
Brigade. And
Brigade. All right, take that point. Thank you so much for joining in and giving us your call on the real estate sector. The sector is doing extremely well, but at the same time, valuations not particularly comfortable at current levels after a big run-up that we've seen in all these real estate stocks. Good time to get in the 9-10 calls. We invite both Sudarshan and Mitesh back again. Your calls, Sudarshan, you go first.
Siemens is a buy with stop under 6,700.
All right, and Mitesh, you?
I'll go with a buy on Escorts for targets of around 4,000.
Okay, all right, gentlemen, got that. Thanks very much. Just a couple of minutes to go before we hit market opening. And, well, let's get you a big announcement. And some good news as far as we, the Indian investors, are concerned. India has displaced China as the largest emerging market in the MSCI EM basket, MSCI Emerging Market Basket. Hormaz has been looking at the data. Hormaz, take it away.
It's good news indeed, and we reported about it last month as well, right? That India has now become the highest weight in the MSCI Emerging Market Basket, and that is what Morgan Stanley has written about as well. Is that it is the largest emerging market in the MSCI IMI, which is the investable mid, small, and large cap stocks. The China's weightage, though, according to Morgan Stanley, has fallen by half since it has peaked in 2021, and now, as per the standings in terms of which market commands what weightage, India now stands sixth in the sixth largest market, just behind France. If you could pull that graphic up as well, it will show that US ranks on top with a 63% weightage. Of course, they're followed by the US. France ranks fifth with around 2.38%. In India is right at its tail with 2.35 and has now comfortably surpassed China, which has now a 2.24% weightage. Now, what Morgan Stanley believes that with now India being the largest in the emerging market basket, it will continue to gain share because of the market outperformance, the new issuances that are coming up, and also because of the improvement in the liquidity factor in the market. So that will drive further gains for India within the MSCI EM. And Morgan Stanley also believes that India's nominal GDP is now in the mid-teens, which is almost 3x of China, and that is driving a profound divergent operating and earnings growth environment for companies of both these countries. So positive news coming in on both for India, the largest emerging market basket now in the MSCI.
All right, the largest emerging market basket. Let's see whether there would be more flows coming in on account of this or not. The valuations, are they attractive enough or not? But let's talk about the stock that everyone's been talking about for the last couple of trading sessions. And it's in the last two trading sessions itself. It's moved nearly 2.6x from its issue price. This is Bajaj Housing Finance that I'm talking about, 181 rupees. 3 days ago, the issue price, which it was 70, logged in 10% upper circuit yesterday as well. And yesterday, nearly 1,500 crore worth shares were marked on the NSE for delivery. What's interesting is that there is this lack of liquidity, which increases the impact cost on the stock itself. The free float market cap is close to 12,000 crores versus the total market cap of the company, which is 1,51,000 crores itself. And for a 10% up move, all it took was 1,500 crore worth shares to be marked for delivery. You look at the number of shares which are available for trade right now before, the first lock-in opens on October 12th, is just 8.2% of the overall available liquidity of the company, which can be traded right now. The rest is locked in. At 1,51,000 crore of market cap, Bajaj Housing Finance is actually more in terms of market cap than the combined market cap of LIC Housing, Canfin Homes, PNB Housing, Aadhar, Aavas, and 5 other companies as well. So 10 housing finance companies put together. The market cap of Bajaj Housing Finance is more than that as well. With this up move, who stands to benefit the most? Of course, the ones who got allotted this IPO. And secondly, Bajaj Finance itself. This morning, we've had a note coming in from Morgan Stanley. They've updated their model on Bajaj Finance after the Bajaj Housing Finance IPO. They said that at current reckoning, Bajaj Housing Finance is trading at 6.1 times. So if you take that value out of Bajaj Finance and, give it a 20% holdco discount, the remainder, which is Bajaj Finance, which is available at 3.6 times FY26 price to book, and that's a positive. So they believe that Bajaj Finance is an overweight with a target price of 9,000 rupees per share.
Better bet to at this point.
Yes.
All right. Well, we've got the market open coming up. First rates, what do we have? It's an absolutely quiet start. It's 25,400 on the Nifty, almost unchanged. We've got the sensex, which is at about 82,973. There is down about 0.15. Bank Nifty is literally blinking red and green, right? 52,188 is where it is. It ended flat yesterday as well. And you've got the Bank Nifty, which is also the mid-cap index, beg your pardon, which is also starting with absolutely nothing on it. So this is what you have on the indices, not very much to show for it. The IT index is down in a pronounced way, although I think this is still very early, but 1.2, 1.3% lower on the Nifty IT index. And that's got to count as one of the big movers sectorally, up or down. So that's Nifty IT for you. The heat map on your screen, I think it's even Stevens, 25 up, 25 down approximately. So that's but just the Nifty. But broader market, there will be lots moving. So let's get to it. Surabhi.
Absolutely. Well, in the broader market, 90 points higher on the mid-cap index. Torrent Power is reacting positively. They've got some power supply contracts in Maharashtra, 4% up on that stock. Some of the other movers include Neogen Chemicals, continuing its rally from yesterday. Remember, it was a big day for not just Neogen, but a couple of other chemical stocks as well. So those are some of the early names. There's Quest Corp, which is up about 3.5%. MRPL, up about 3% as well. Actually, speaking of MRPL, let me check on the other stocks. Oil India and ONGC also managing a little bit of green because of the cut in the windfall tax, about 1% higher. But it is very quiet in the market, you'd have to say, on the mid-cap screen as well. There's not too much moving around. Suprajit, the company we just spoke with, down about 1.5%. So, yeah, it's absolutely quiet. One trend that really, is continuing is the fact that IT is absolutely on the back foot right now. LTI Mindtree, Wipro, Infosys, Tech Mahindra, TCS, HCL Tech, all IT stocks on the back burner on the Nifty. And the upside is coming through Bajaj Finance, by the way. Mangalam was just talking about that Morgan Stanley view on how probably it's a better way to play the whole financial services group, the Bajaj group, that is. That stock's up and about. There's some buying on Britannia, Lever, ITC. Basically looks like it's even Nestle for that matter. So it's basically back to FMCG till the global clouds part, and we know what the Fed wants to do.
We know what the Fed wants to do. For the second day running, we are seeing some traction in Torrent Power, REC, PFC doing extremely well. On the way down, again, you have, the top 5 losers in the F&O space are all IT stocks. Emphasis, Oracle Financial, you have Persistent Systems, L&T Tech, and Birla Soft. So the top 5 losers in the F&O space are all from the IT pack. For the second day running, we're also seeing some traction in Tarmat Limited. Remember, yesterday that stock was locked in the 5% upper circuit after getting an order worth nearly 140 odd crores. So that stock's doing well. I'm looking at Emcure as well. This morning, Emcure is up 3%. There's a Kotak initiation coming in on Emcure. They like the stock. The target price that they have is 16.55. So that stock's doing well. BSE is bouncing back today, so up around 3% at the open. We'll keep an eye out on that one. And the stocks which are not doing too well, we are seeing some bit of a decline in names like Bajaj Housing Finance. Opens about 2% lower. Let's see where that goes. You have Zaggle Prepaid, Titagarh Rail Systems, Century Ply. We'll have to go down, the volume radar to look at stocks which are moving on the obverse side. Largely flattish, but a few individual stocks doing extremely well. Even the alcohol space continues to do well. Radico Khaitan up another 2% this morning.
Absolutely. 30 points lower on the Nifty is what we have. We're at about 25,386 as the first few minutes of trade. REC and PFC, I think we highlighted these. I mean, they've been consolidating for a while, but they're making a bit of a move right now. So 2% on each of them. Now, IT is something that I was highlighting, right? The index started 1.5% lower. But I mean, you look at biggest volume-led loser, a lot of IT there today. TCS is down 1.3%, should come up. Infosys is down 1.5%. I mean, these are not usually on the top of the volume board. But they are today. So on the downside, there is Emphasis, which is down 4%. Emphasis is seeing a bit of a cut. I'm not sure if there's any news flow or something out of the US which we're missing because the sector is down. Oracle Finance is down about 2.5%. Persistent is down 2%. There is LTI Mindtree, and we should put some of this up in terms of alerts. LTI Mindtree is down about 1.7%. Wipro is down 2%. So, yeah, I mean, these are 7, 8 names that I read out from the IT services pack. And, of course, it's showing up with the IT index being down 1.3, 1.4% that we highlighted earlier. So that's IT for you. Apart from that, Blue Dot went up like a rocket yesterday, 10, 11%. And I think it's coming off a little bit right now, 3.5%, just a pullback basically. ECOS Mobility went up sharply yesterday. Recent listing, it's a fortnight old in the markets, 1.5 lower. Godfrey Phillips was down 3.5%, 4% yesterday. It's down another 3% this morning, 75.35 or so on Godfrey Phillips. Titagarh is down about 2.5%. Natco, Century Ply was up sharply. That's down about 2%. We were highlighting and we spoke about Zaggle yesterday. Wonderful month so far for Zaggle, up 30%. It's down about 2%. But these are just broadly in the nature of some profit booking. But there is more IT, which I did not mention. HCL Tech is also down 1.5%. Tech Mahindra is down 2%. Birla Soft is down 2%. LTTS is down 1.5%. So there's a fair bit of tech on the red side, on the downside, which is coming up. Guess what? The biggest volume-led gainer in terms of the broader market now is Ola Electric once again. It's up 3% after yesterday's 10% move higher, and it's at about it's at 121. Ola Electric, 17 million shares on it on your screen. So big one. BSE, of course, we highlighted 5% higher. Very quickly, it's jumping. Day before yesterday was a massive move for BSE when it moved up that 15% plus. And of course, the buzz was coming out of that weekend that the NSE listing is perhaps one step closer, but not that close because there's no other discernible news flow for BSE, and it's moving up today as well. Torrent Power is up 3%. We highlighted PNB Housing had rallied from 800 to 1100 and has been consolidating. I think pulled back after the Bajaj listing. It's back around 1100 levels. 4% pop on PNB Housing. Radico is up 2.6%. Alkyl Amines is up 5% this morning. Panacea Biotech, PG Electroplast, Quest Corp, these are all in the region of being 3 to 4% higher at this point in time. So that's the market for you. Just about 10 points lower on the indices, not very much happening, but as we highlighted, a fair bit happening as far as broader markets go. Mangalam.
A couple of stocks, spiking right now. Bandhan Bank is the one which came out of F&O ban yesterday, currently has moved well, so that's higher in the green. And we are seeing some profit taking in names like Blue Dart. Blue Dart was up with big volumes yesterday, up around 10%. So currently lower by about 3%. VST Industries is the other one where we had, some pairing of stake by Radhakishan Damani. That stock's down about 2%. And for the second day running, we are also seeing some profit booking in these regional jewelry players. So TBZ, for instance, down about 4% after declining yesterday as well. So this week, the cuts are about 10%. And Kohinoor Foods, it's had a phenomenal week, a phenomenal month, and now comes down for some selling. So we'll keep an eye out on this one too. So those are a bunch of stocks.
All right, absolutely. So we'll keep an eye out on these names. Andrew Holland is with us with some perspective on markets. He's Chief Executive Officer, Avendus Alternate Strategies. Andrew, good to have you with us here. Thank you for your time. IT services stocks are down and, all together. Is this ahead of the rate cuts? I don't know why they should be down. Or are you picking up anything else? And what's your view there on that space, Andrew?
So I haven't picked anything up. I saw something yesterday, Prashant, about Accenture saying that they're delaying any kind of promotions in the company for 6 months on the basis that, it's still uncertain, the kind of global outlook. So I don't know if that's something that might be worrying markets, or the IT sector. But that's the only thing I picked up. You would have thought that ahead of the rate cuts, it would be, a more kind of tailwind for the sector, particularly given it would be good for the overall tech sector in the US. So I could only presume it's something to do with that.
Yeah. A viewer just tweeted to me essentially saying the news item is this: Accenture is going to delay bulk of promotions by 6 months on their outlook. And the company said, and I quote, "We are permanently changing our primary promotion date from December to June, which is when we have better visibility of our clients' planning and demand." So this is the news flow which Andrew is referring to. So
yeah, I guess that could be it. And maybe some nerves, and I don't know, I'm just guessing over here, that IT has actually done fairly well in the last couple of weeks till we've sort of, in the run-up to the rate cut, and maybe if it is a rate cut and you get back into risk-on mode, maybe the market's mode swings back to the more of the capex plays, manufacturing, the original favorites. And that's really the question. Andrew, hi, morning, great to have you on. That's really the question. In this whole run-up in the last 2-3 weeks, we've seen a bit of sector churn, some money going back in FMCG, definitely going back in IT. Now, if the Fed does start delivering, whether it's 50, 25, and it's a series of rate cuts, then what do you think will the market mood be in terms of what to pick?
So one of the sectors which we talked about last time when I think the inventories were very high in the auto sector, I said I still think that was a good time to buy. So, that's been a great performing sector. I think what I would do now is move out of that sector. And let's just say, Serbia is going to be 50 basis points. If it's 50 basis points, then, the RBI comes into play for October, for sure. And that would be great for two things. One, it would be great for the banking sector, private banks in particular. But I would say that the NBFCs are more, probably, gain more in that kind of run up. So that's the switch I would make. Also, Given that the dollar is hovering against DXY is around 100, anything below that's going to be great for metal. So I think the play on a 50 basis point reduction is financials, NBFCs in particular, and metals. So those are the plays I would do depending on what Federal Reserve Powell does tonight.
And that's an interesting point, Andrew. But just to follow up, typically the RBI always retains and always projects a very, very independent view, right? And in the last policy, I remember categorically the governor was keeping a hawk eye on inflation. It was a bit of a hawkish pause. So would you really expect the RBI to move as early as October? And of course, then, that kind of predicates the call on NBFCs and the lenders.
I think, I mean, you're right. I mean, he's always been cautious and done a great job. So I can't really argue with his interest rate policy over the past few years at all. But I would say that gives him the opportunity. The economy is slowing. You're seeing forecasts being brought down. The deficit is rising because of lower exports and so forth. So I think he can afford, if there's a 50 basis points reduction, he can afford to do a small change, or at least increase liquidity with a much more dovish kind of stance, which will then say that we know December's in play, and we know what's happened with the U.S. markets, right? When we know something's in play, you've seen the markets move a lot higher and a broadening out of the stock selections as well across the U.S. indices. So that's what I would expect to see here as well. So that's why I think even if it's 25 with a very dovish, aggressive stance towards cutting rates, you still have December for the RBI, and therefore those sectors still play out well in terms of financials and of course metals because of the weakening dollar.
Well, you spoke about financials and you've actually handed it to me over a platter, because the one financial stock that everyone's been talking about over the last couple of days is this big listing of Bajaj Housing Finance, currently at 1.5 lakh crore market cap, closer to 6 times 2-year forward book. What's your call on this one?
I can't make individual stock calls, but I've been obviously seeing a lot of research come out, and I think one report today talks about the very small free float of the company, which is helping. But I think the price is again baking in a lot of what I've just talked about. So I think there's other players within the sector which you could actually kind of buy on the basis that they should actually kind of close that gap in terms of valuations. Because if we're all valuing one company so highly, it can't be that everyone else is so bad.
On the financial space itself, another way to play this is the capital markets theme. And this morning, some of these exchanges are doing extremely well, including the likes of MCX, BSE. Not talking about individual stocks, but I mean, how would you, what would your view be on playing the financial space itself through the financial market platforms?
Yeah, I think again on a longer term view, let's just take the kind of market capitalization. If we say that that's going to be equal to GDP in the next 2 to 3 years, so that's what 4 or 5 trillion. The capital markets are going to continue to grow very, very strongly. So AMCs and exchanges are one of the ways to play this. And of course, if NSE is listed as the kind of reports I'm seeing looks likely, then I think all of these exchanges will get an extra fillip as well. So I like the exchange, the play on the overall market, followed by AMCs.
Okay. Andrew, on the overall market, what's the sense? We keep talking about these all-time highs and the valuations and whether earnings will keep justifying where we are. What's your sense? I mean, is India still good for more?
See, earnings survey are not justifying the valuations because I'm seeing only downgrades since the last quarter. Government spending really hasn't kicked in yet, and private capex is still to kind of pick up to the levels I would like to get that multiplier effect where we could go into the second half of the fiscal year saying, okay, earnings will start to increase again. I'm not seeing that. So but you have a tidal wave of inflows into the domestic market, and that's hard to fight against. That kind of it's just washing away any kind of fundamental views for the time being. And I think that's going to be the case for a little while longer. So I think liquidity-driven markets always worry me. So it becomes more tactical. It becomes what I just mentioned before, maybe switching from autos to financials and NBFCs. So you're getting those trades. But it's to buy some of these companies on the ratings they have is going to be a long haul to get those returns, in my view. So it's pure liquidity. So you can't fight it. So you have to be with it.
No, absolutely take that point, and that's not an easy market for a stock picker, a fundamental stock picker to navigate, right? Because it has to be far more strategic and tactical than just purely looking at earnings. In which case, let me ask you the other question. I mean, we're anyway dealing with this tidal domestic liquidity wave. Are you expecting any sort of a mini tide or a mini wave of foreign liquidity as well, which so far has been missing? I mean, it's coming in all the block trades in the secondary market sort of dealings. But in terms of just pure buying, cash market buying, are you expecting that to pick up after this rate cut at all?
No, I mean, rate cuts are always good for emerging markets as the dollar falls as well. So yes, we will get flows. The key is really, will the flows continue to be kind of more passive? I know you talked about individual stocks in terms of QIPs or block trades or IPOs. That will continue. But that's not really kind of individual kind of funds coming into India. So I think the allocations are being more passive. I think the key for India remains what happens in China. And I was speaking to one of my broking friends who had just recently had a conference in Hong Kong, and they were saying, the sentiment towards China is so poor and so low that the money's just coming to India. But beyond the normal kind of nifty or the large cap stocks, is getting into the 200, 250. So that's the good news in terms of the broadening out of FII flows. But much will depend on China. If China can turn around its economy and get the stock market going again, then I think you would see more flows towards China. That said, we've still got the presidential elections in the US, and obviously if former President Trump was to get in, then tariffs would be a very big play, and that would hurt China, along with the rest of the world as well.
Yeah, let's see. I mean, I guess economic policy is going to be very interesting in the US to watch, because if it is not Trump and if it is Ms. Harris, then there's a lot of chatter about higher domestic taxes, right? Corporate taxes. So let's see how corporate America and investors deal with that. But thank you very much, Andrew, for joining in.
My pleasure.
It's been a pleasure to have you on. So there we have it. The market, for the time being, absolutely flat. 12, 13 points down. No moves whatsoever.
No, absolutely no moves whatsoever. And we're at about 25,400 or so. Let's put the focus on, financials business, right? Very high quality financials business, highly rated, and business which most investors love to own. I'm talking about Chola Finance. And we've got the management now joining us. Arun Selvan is President and Chief Financial Officer of the business. Mr. Selvan, good morning. Great to have you with us here. Thank you for your time. Prashant this side. We're on the cusp of rate cuts, sir. Rates went in globally 0 to 5% in the US, and now they are going to come down, at least 75 to 100, if not more, basis points this year. Although in India, if you talk to money market folks and economists, etc., the first cut is only in December. So there is a bit of a gap when we start to see rate cuts here. Just your thoughts, Mr. Selvan. For your business, what do lower rates mean? What's the profile of your liability book in terms of maturity? How fast can you reprice? And I also believe that you recently raised some money, right? At a 9.5 coupon rate, 9.5%. So if you can just sort of contextualize that with what you see going forward. Go on.
Yeah, the recent raise which you referred to as the 9.5 is a perpetual debt, and that's a Tier 2 capital. So that's not the normal rate we raise money for our normal borrowings. The better reference would be the ECP loan which we did recently, which is also in the news, which is at around landed cost of around 8.3 fully hedged. Coming to the rate cut part of the discussion, that is, we need to see how RBI reacts to what the US drop is, how is it getting translated in the Indian context. Yes, if it does follow suit, which I think would be more in Q4 rather than even in Q3, then yes, it would benefit us. We would prefer or we would love to have a earlier rate cut, but my guess would be it would be a little later because we still have the overhang of the inflation to address, and RBI may take its time to follow the rate cut, at least with a lag of a quarter or so. But if it does so, then yes, almost I would say, because a large part of our bank borrowings are indexed on EBLR, which is a benchmark to the indices rather than to the MCLR. We would see the benefit translating into NIM improvements as we move into the subsequent quarters. We should have a NIM improvement coming through if there are rate cuts.
So what percentage of your liability side is benchmarked to these on the EBLR side? And because even if RBI only cuts in December, expectation is because the interest rate differential will be very large. A lot of money will come into debt markets, into government bonds, etc., and that should lower some of these indicators to which you're also tied to on the liability side. Could you give us a sense of your liability profile and how will that impact? Wouldn't you pass it through those so directly? So will there be any improvement really? Go on.
Yeah, so to give you the breakup of the liability side, nearly 50% of our borrowings are from banks, of which I would say are almost 60-65% is benchmarked with the indices. So that would translate in, with at least with a month lag or at most a quarter lag. So that would come through. Now, the other point you raised about the markets pricing the reduction, yes, they will do, but that would only impact the incremental marginal borrowings from the market. Whatever we have done in the market on the NCD front, which I would say the market borrowings right now would be in the range of around 20 to 25%, that would not get altered because most of my NCD borrowings are fixed rate borrowings, so they will not change. So that would continue to be at the same levels and has to be run down. That's where I said if we would only get around 50% of the rate cut, broadly coming through, which will translate on fresh borrowings from the market plus the repricing of the existing borrowings from the banks.
So two-part question.
Right. Go ahead. Sorry. No, we have securitization book, which would also get, some of them will get repriced, some of them are on, fixed rates. And then the ECBs, we are seeing the rates coming down. That's why we did a large ECB even just this week back. We got 300 million coming in and we have a few more lined up. So those things would benefit us as we see rate cuts happening.
So, on this itself, I just had a two-part question. One, you said that your NIMs could see a positive improvement. If you could give us a sense of by how many basis points, would it be 10, 20, 30, 50 basis points? They've been between the 7 to 8% mark for a while. And the second part is on your, loans itself. How is offtake right now, and at what rate or what yield are these offtakes versus the older books?
See, that's where I said we will, whatever is the rate cut that is happening, we would see a benefit of almost 40 to 50% of that coming through over the next quarter. So if there's a 25 basis point cut, we should see a 10 to 12 basis points, improvement in NIM. This is purely, I would rather not even say improvement in NIM. I would rather say it is a reduction in cost of funds. Whereas, how much of this will get passed out to the our customers would also would reflect how, because on the proportion of the fixed book versus the floating book. On the fixed book, which is almost 58% of our book, which is vehicle finance, is fixed. There we may not have to pass on, because that we like how we absorbed the rate increase during the period when the prices went up or the interest rate went up. Now is a scenario where we may benefit when the rate cut happens and that book remains fixed. But on the mortgage business, we will have to pass it on depending on how the market pans out and how much rate cut that we get, and how much of that tenor based is linked to each of these mortgage business loans, and that we would be passing on. So there may be some reduction. So net, that's where I'm seeing around 40 to 50% of the rate cut would sort of reflect in our NIMs.
And your offtake, the yield differential between your previous loans and the current loans that you're giving, because the street believes that you are giving out newer loans at slightly higher prices as well.
Yes, see, that is a result of two things. One, the change in the pricing. The other is the mix in the product. The product mix also is changing. So when there is a large rate increase happening, we move out of low yield products like heavy commercial vehicle, for example, and then focus on higher yield products, because at that rate level it is not viable to reach our return on total assets, the ROTA, that we would be targeting to achieve. So we slow down on heavies. If you observe, we would have slowed down over the few last 2 years from almost 6-7% of the overall vehicle finance AUM. It has come down to around 4% now. So we slow down on that, and then focus on other areas like two-wheelers, tractors, three-wheelers, which are of higher yield. So the mix change also results in yield improvement. So it's not like a straight, simple, vanilla one product company where you can track it exactly how much all of the yield increase is attributable to the price change only.
Yeah. So all things put together, Mr. Selvan, really appreciate you being very granular, because these things are complex, right? I mean, you have the liability side and see how much that gets repriced down, and there is the asset side, and there the mix really matters. All things put together, margins for the company have been between the 7 to 8% band, right? You are in the middle of the band as of the first quarter. Because we're in a softer rate cycle, and in all probability we'll see rates head lower here in India as well, should one assume that you can perhaps end the year closer to 8% on the net interest margin? Would that be a fair assumption to make?
I would say let the rate cuts happen, and then I will give you this commitment, because, we are building on assumptions here that, yes, I know they are looking more factual, but we, as you know, we are a very conservative company. We try to commit only when, we see things happening, in reality. Otherwise, if I just, people will forget that it is conditional to the rate cut, and then they will hold me to the 8% mark. So I would
fair point, sir. No, we understand. I mean, these are nuances that one has to take into account. So let the rate cuts happen. Let the RBI project its path. Right now, we're only dealing with the Fed's path. So completely take your point. On the subject of growth itself, I think in our earlier conversation, you did mention that, on a steady state basis, you would look to grow the book by at least 25% every year. But looking at the second half, now I just want more of a here and now projection. Second half, CVs, from what we see in the numbers, I mean, there is no pickup as yet. The business still seems to be flat. So what will be the credit growth drivers for you? And also just tell us about the new business, because the market believes that could fetch you higher yields. So just tell us about that mix, where the focus will be and where the growth numbers will come in the second half.
Surely. Even in auto, we have been shifting from the new vehicles to used vehicles, and used vehicle demands is really, robust, I would say. And so we are able to still clock at around anywhere between 10 to 15% growth in the vehicle finance book, which on a larger base translates into a large absolute number. The focus, of course, is to grow the mortgage businesses, which is the LAP and the home loans, which would actually grow, above the 30% mark over the next at least 2 quarters if everything pans out well and the rates remain robust and the rate cut does really translate into reality. The new businesses which we introduced over the last 3 years, which is SME, CSEL and SBPL, they will also grow faster, albeit on a lower base because they are very small right now. All three put together less than 15% of the overall book. So while the growth percentage will look larger, but their absolute incremental addition to the overall AUM will remain, still a smaller number to go by.
Got that. Mr. Selvan, very briefly, if you can give me a 30-second response to this. You did mention ECBs a few times. Will you go in for that route more? And why is that? You can do it because you're rated as you are. Many NBFCs cannot. Is the liquidity condition still quite tight locally?
No, look, see, for me, the benchmark is which gives me the lowest rate. Because there is a easing of the forward rates, and in ACBs our guidance from the board is to completely hedge it, both principal and interest. So I look at it at the landed cost. If the landed cost is comparable to the local market or better, I go for it.
All right.
So we are selective about the ECBs. We try to do only through banks which have got presence in GIFT City, so we can not get impacted by the withholding tax, etc. So we are very selective, and our spreads over SOFR which we give have been negotiated tightly. So our landed price in all the ECBs we did so far is lower than the local domestic market pricing.
Oh, wonderful. Thank you very much. Appreciate you joining us, Mr. Selvan, and we'll speak again soon. Thank you. Well, we'll take a quick commercial break here. We are going to be joined by the management of Happiest Minds to discuss their growth outlook as they complete 4 years as a listed company. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. Let's talk about Happiest Mind Technologies. The company has completed 4 years on the bourses, has seen a strong run since listing as well. And they've also set themselves a target to reach $1 billion in revenue by 2031. So to discuss more on the company's growth outlook, we're now joined by Joseph Anantaraju, who's the Executive VC and CEO, Product Engineering Services. We also have Venkatraman Narayanan, who is the MD and CFO of the company. Thank you so much, gentlemen, for joining in. While we talk about, the long-term prospects, a great run that you guys have had, and more importantly, the outlook for the company in the near and medium term, just as of today, there is a wave of weakness in all the IT stocks, and that's led by some sort of concerns around Accenture saying that they have put on hold promotions for the next 6 months. Are there any demand-related concerns? What are what are the feelers that you're getting when it comes to demand currently?
So, I think at the beginning of the year, we gave our guidance for this year, and we feel quite comfortable with the guidance that we've given and that we'd be able to meet that for the current year. I think the two acquisitions that we made, they've got off to a good start in terms of being able to cross-leverage capabilities both ways, from a domain and from talent and staffing perspective. Having said that, I think we need to keep a close watch on the market because there are a few factors. You have the election coming up. You have some of the geopolitical developments that continue to linger on. So we need to continue keeping a close watch. But we feel comfortable with the guidance that we've given and the kind of traction that we're getting with our customers for our offerings.
Joseph, hi. Great to have you on, and congratulations on the milestone. So just to go back to the mood, when we spoke to you, I think earlier, just after the first quarter performance, you did indicate that things were looking good. In fact, I think consolidated revenue growth was as high as 10%, your acquisitions plus the organic put together. So is it still looking as robust? We're just alluding to this recent news development on Accenture pushing back its wage hikes by 6 months. That, I mean, headlines like that make everybody sit up and take notice and wonder what's going on. Your thoughts?
So, and if you look at a company like Happiest Minds, being one of the advantages of being relatively smaller is that the incremental revenues that we need to get is not high as some of the large companies. So that's a advantage that we have. We've gone ahead with our wage increase for most of our people. We break it up into 2 cycles. We have the junior and mid-level that we do in July, and we've completed that. And we'll be doing the next one in October. And we had a discussion internally, and we felt that given the revenue and growth outlook, that we could go ahead with our wage increments for this year, keeping in mind, the kind of market condition and other things. So that's what we've been able to do.
And just to sort of understand that, wage hikes, just in terms of quantum, have they come down? Because anyway, now you're not dealing with as high as attrition rates. And overall, I mean, that whole, massive attrition issue that the IT sector was grappling with, that's a thing of the past, right? So what could the potential wage impact be? Because I think in an earlier call as well, you'd called out to the possibility of maybe a slightly more softer second quarter because of lower working days, and part of your wage hike is also happening in Q2?
Yeah, that's what we had said. We had alluded to a drop in margins because we would be taking the full impact of the wage hike for Q2. For the substantial part of the people, the wage hike is effective July 1st. So that will impact Q2 to a certain extent. And as you rightly pointed out, the lower number of working days. So that's baked into, our overall forecast of margins. We have been giving you a number of 20 to 22%. Q1 was close to 24%. So we are trying to, address that. We have also called this point out that we have been standing apart from the markets or the other companies who have been pushing out wage increases, who have been, giving much lower numbers than what typically one has seen in the past. So we have, and maybe even, addressing or adjusting variable pay to make up for the profitability. Thankfully, we have not resorted to any of that. We have gone ahead with our wage increase, which is, I would say, high single digit on an average across the company. We have gone ahead and paid our variable pay as per commitments. And also, we have not pushed out any wage increase cycle. So that said, as we said at the beginning of the year, we are looking for one of the best years since our listing. Like you rightly covered, it's 4th anniversary of our listing. Just to put things in perspective, when we listed the year FY21, we were at about 797 crores of top line. Since then, we have grown 115%. In FY24, we closed the year with 1,710. That's a massive growth of 115 years in 3 full financial years. EBITDA has grown from 215 crores in the year of listing to 421 crores, which is a 96% growth. People numbers, we were 3,200. Today, we are close to 6,200. $1 million customers from 26 to 58, 123% increase. Shareholder numbers, when we closed our IPO, it's a very big IPO. We had 2 lakh shareholders. Today, we have got 7.5 lakh shareholders. So on all metrics, we are doing well. And we are looking to a
you're doing well on all these metrics. We take that point. While your revenue has doubled from the time you first listed, the share price has moved 5 times. So obviously, what the street expects for the future is a lot more than what you've delivered in the past. But Prashant, you had something.
Some fantastic numbers there. Congratulations to both of you and the teams at Happiest Minds. From me as well. Good morning, Prashant here. Mr. Joseph, if I can come to you. You said, right, you're a smaller company, but big ambitions. That $1 billion revenue target, which we've sort of talked about in the past as well, over a period of time. Now, my question is, we are at the cusp of interest rates in the US starting to come off. Some of your larger peers, when we speak to people in the IT services sector, we've heard this higher rates in the US impacting demand, especially discretionary demand, to which you are exposed to in a meaningful way. Could you tell us if rates start to come off, could we see meaningful acceleration on the discretionary side of your business?
Sure. So, I sort of clarified this earlier as well, Prashant. The work that we do with many of our customers, they don't look at it as discretionary because you're working on the platforms that they are using to either interact with their customers, in some cases drive e-commerce, or in a few cases to manage their internal employees. But in most cases, the work that we're doing is more platform that's customer facing. And these are, once the customer has to make investments to first build these platforms, and then you need to keep adding features and functionalities. So we work with our customers as an extended team, and in most of the cases, and therefore the budgets kind of roll over from year to year. There could be a small variation. From that angle, it's not really discretionary. I just wanted to make that point. And in terms of the outlook, I think once we do have the interest rates dropping, and hopefully we'll get to hear in the next day or two, and we have a couple more hopefully this year, I think that will add to the positive sentiment and ease up whatever constraints that customers had. So we should see an improvement in customer outlook, and I'm really keenly watching out for how customers play out their budget in the November-December timeframe.
Okay, just one last question. Last time we spoke, you talked about a Gen AI business unit you'd set up, and you said that, well, you're starting to get work, but a smaller size, right? $100,000, $150,000. How is that scaled up? How many people are there in that unit now? And could you give us some projections there?
Sure. So when we last spoke, Prashant, we had said that we had around 50 discussions around a month and a half back, and I can say that in the last month and a half, we've added another 10 discussions that we've had with customers. So you can see, that the momentum building up. And in terms of the number of people, we have around 125 to 130 people that are part of this team. But equally important, that's the core GBS team, right? That have capability on GenAI, on Llama, on various LLMs. But we also made sure that 85 to 90% of the rest of the happiest minds is also trained on GenAI, and we plan to cover the whole company by, let's say, latest Q3. So that way we would have flexibility in terms of staffing our projects. What we are seeing is that there's a lot of interest and excitement still in the customer base and among some of our prospects on how they can leverage this technology. And I think this is one of the areas that we are looking at to really help us get to our billion-dollar goal.
Sure, absolutely. I think this word, Gen AI, this is here to stay. It's not going away from conversations anytime soon, and we look forward to hearing more about it as your plans scale up as well. Thank you very much, gentlemen, for being with us. Congratulations once again on your 4-year listed journey and completing that milestone. Well, let's move on and put the spotlight on Easy Trip Planners now. The company is foraying into the medical tourism segment. The board has approved 2 acquisitions worth a total of 90 crores. To talk more about this, we have with us Prashant Pithi, co-founder at easemytrip.com, Easy Trip Planners. Prashant, great to have you on. I want to take a step back because I think there's a fair amount of interest around some of your recent announcements. It started from the move of getting into EV buses. Now you're looking at partial stakes in a company that provides home healthcare and in a company that provides, I think, health supplements. So what is the broad thought process? And you're putting a fair amount of cash to work here. Let's start by talking about the cash level within the company and the cash allocation policy. What exactly are you thinking?
Well, firstly, thank you for having me and asking me a broader question rather than a specific question, because as you rightly pointed out, it seems a little bit of a shift of a strategy. And I'll give you a rationale around it. Well, EaseMyTrip is one of the unique internet companies which have gotten itself to a level of getting listed without ever raising any fund. And which is why probably you could assume that the management and the promoters own certain skills which are not very common. And hence, at the board level, we have decided that we are going to basically go a little bit diversified and help bootstrapped internet companies to grow faster by providing our advisory, by providing our technology, by providing our understanding and business ethics, and help them to get to a place where they can be listed in the next couple of years, and by taking minority stake in their company. So this is the overarching thought process behind. However, in the case of EV, there is a different need for which we have gone ahead and announced that we are basically setting up a manufacturing unit. You would already know that we have a bus company called as YOLO Bus, which is doing fantastically well for us. At YOLO, we have about 80 odd buses already. Now, EV buses provide it provides an amazing cost dynamics in terms of costings, in terms of operational cost, and in terms of servicing and everything. Because of which, since last one year, we were on the lookout to find a supplier who could provide EV buses to us. And since there is a huge, tremendous short supply on this side, and we want to grow YOLO Bus to around 2,000 buses in the next couple of years.
Prashant, sorry. Let me come in over there because it's very clear that these are two very different things that you're talking about. So let's take it one by one. EV, which seems to be a more strategic business call where you're interested in getting in that side of the business. And the other part that you mentioned, I'm going to just take up that first. You said that you want to bring some bootstrap startups to scale and maybe, help them with their funding needs. Just expand on this, because 90 crores is a fair amount of money that you've put to work on the other two acquisitions, right? So this reminds me of maybe the Info Edge way. I mean, do you want to go the Info Edge way, so to speak? So will they remain strategic? And again, the numbers. What is the cash level in the books right now? And how much have you set aside for this sort of incubator business that you seem to be thinking of?
So firstly, for these both deals, there is no cash component. These are equity swaps. So, but I'm not saying that in future there cannot be a cash deal. And you may be pointing in the right direction. Very shortly, we are also coming up with a framework on how we basically would be providing our expertise, our advisory, our consumer base to such companies, which we believe could become the next eSmartTrip. Basically get listed in the next couple of years while remaining bootstrapped, or probably just raising once using eSmartTrip. We are considering naming this incubation as Raise Once. In fact, on your TV show, I could even say that we have actually already created a website called as raiseonce.com. And this is basically our thought process by which we have basically taken a call on these two companies.
That's very interesting, because most on the street would have betted on the prospects of travel increasing and them growing with Ease My Trip as against, getting exposure into all these funds or all these companies that you are investing in. A specific question on these two companies itself.
I would like to clarify on the point which you just made. The travel business is anyways growing. As you can rightly see that since the listing, our travel business has actually grown by almost 4 times our profitability.
Yeah, we get that. So maybe,
this is more with regards to providing advisory and not being in controlling stake and running those companies.
Okay, so let's talk about that itself. P-Fledge Home Healthcare and Rollins International. What is the current revenue and profitability of these companies? And what is the growth that you are projecting for these before the IPO, say, in the next 2 years?
So let me speak specifically, let's say, from Rollins' perspective. Rollins basically is a diversified company itself. They provide 3 services. The bigger business of them is basically providing cutting-edge, science-backed, best-in-class wellness devices to individuals and also to corporates and hotels. One of their bigger clients are basically hotels, and this is how we actually got in touch with them. If we could basically provide their hyperbaric oxygen therapy chambers, their cryotherapy chambers, their infrared red light therapy-based beds to various 5-star hotels in India, with which we share very deep relationship. As you would know that this company is basically a subsidiary of a Singapore-based company.
On their revenue and profitability, Prashant, if you could give them, because what they do, you've given in the press release.
This company was about 20 crores and profitability was about around 2 crores for this company.
That was for Rollins. And the other one, P-Fledge?
So P-Fledge numbers are, yet to be finalized for the last year, and which is why I may not be able to share. However, P-Fledge, one of the bigger divisions, what you see on their website is actually a smaller business for them. The bigger business for them is basically allowing people in the Middle East and CIS countries to travel to India for medical tourism purposes. So, which is directly in line with what we are doing. This will surely be able to bring decent amount of business to eSmartTrip as well. As you know, our Dubai business is growing tremendously. Last quarter we did business of about 126 odd crores. We believe that PFledge will be able to add substantially to the numbers of eSmart Dubai business.
If you could give us a number of how much does that substantial mean? And 20 crore is the revenue of Rollins. How much do you plan to scale it up by once you've invested?
So as you could see that this is basically an equity swap deal. What we are providing to them is our advisory, our connections with various hotels, and also guiding them on in the process of becoming a listable company in next couple of years.
Okay, just very quickly, Prashant, I know this requires a longer conversation. We'll be very happy to have you on for a longer one. Going back to the EV business, again, how much are you looking to invest over there? And leave us with the big picture. Because now we're talking about sort of three different businesses. There's the core travel business, there's going to be this EV buses business, and some of these strategic interests that you're taking in these companies. So on EV, how much are you looking to invest? And at a broad, top line and margin level, a year down the line when FY25, FY26 numbers, what should we expect given this diversification that you're getting into?
No, happy to answer this question. And since you have asked me a broader question, let me also tell you a broader perspective. For any intercity travel which is happening in this country, around 50% of intercity happens via train, which is pretty much what IRCTS and Indian Railways cover. It's not as private. Around 40% is by bus, and remaining 5 to 10% is all by private vehicle or airline. So this is how big the intercity bus space is. And we are eyeing to basically become a formidable player in the name of YOLO Bus. YOLO Bus, since the time we have taken that company, we have grown it from 4 buses to about 80 buses. In the next 3-4 years, we are looking forward to see YOLO Bus to have at least 2,000 buses running under them, and primarily on the EV side. Which is why we have taken an initiative, and while we were figuring it out how to find the supply, we realized that there's a huge short supply on it, and the demand could come from various state governments as well to basically order for EV buses, which is why we have decided. And at some level, we thought that should we do it outside the company? But then we realized that if we do it outside the company and supply the buses to YOLO Bus, which is 100% owned by eSmart, it probably could create a conflict of interest. And in order to avoid that conflict of interest, we have taken a call to basically keep it as a part of the eSmart. Anyways, it's a beautiful growing industry. It's supposed to grow at 24% CAGR basis for the next 10 odd years. And which is why we have taken a call to basically do this. Right now, we are in the process of doing the R&D and getting to the best technology. And we have also hired Mr. Manoj Soni, who's a senior veteran. And we have hired him from Ashok Leyland as a CEO of this company.
Yes, absolutely. I know we had a chat with some of the top management that's going to run that business with you. And we look forward to more of those conversations to understand the contours in more detail. Thank you very much for joining us and giving us an overview of the business slight diversification that's underway at Easy Trip Planners. Back to the markets, we have Mitesh back with us. Mitesh, so what are the calls now? What trades?
So I think today while the banking pack is doing well, and that's something which I've highlighted, I think today what would be very important observation is that the IT pack is clearly showing signs of breakdowns and profit booking on the hourly, 2 hourly, 3 hourly chart. So I think that's where selling is. So because you've been trading with long bias, I think I would want to initiate some sell calls on IT names. So TCS, I would suggest selling. Keep a stop at about 44.57, 44.58 levels, around those levels, and look for a decline to roughly about levels of 42.50, 42.60 on the downside. And the other one on the radar is Persistent, which is also down by about 3.5% already. So here I think I would recommend selling with a stop at about 52.30 and a target of roughly around 50.20 can be looked at.
Today's rocket move on the upside is BSE, 13%. By far the biggest volume-led gainer. I mean, if you can have that up. So 3760 or so on BSE Limited. There you go. We'll put this to Mitesh later. Mitesh, thank you for joining us for now. We have to take a quick commercial break here. See you on the other side.
Welcome back. Let's straight away get to the commodity action now. We have Manisha with us. Manisha, so what's hot? What's on the radar?
Well, I'm looking at edible oils, and you might want to watch out for the edible oil companies and FMCGs, because in the latest, what the Indian government has done is, and this is Food Ministry urging the edible oil industry to not hike prices for the retail consumers, where the edible oil associations have been told to maintain maximum retail price of edible oils till the earlier imported stock has been exhausted. Now, the earlier imported stock has been imported at the tune of 0% to 12.5% basic custom duty. And the understanding from the government papers, and this is as per PIBAs, that nearly 30 lakh tons of stock of edible oil has been imported at a lower duty. Now, remember, this was only in this week itself that we saw India hiking basic custom duty for edible oils, refined and crude both, by nearly 20%. Now, when you look at a duty on crude, soybean, palm and sunflower oil, that was hiked by nearly 27.5%, and the duty on refined has been hiked to 35.75%. Now, the duty hike is expected to support the domestic farmers, also manufacturing industry, which was looking at a very lower margin because the import was at real cheap levels in sense of refined itself. The manufacturing industry has seen given a big thumbs up to this one, and also the new soybean groundnut crop arrivals will start coming in the month of October itself. The increased global production, higher global ending stocks, surplus crop expected in the global markets and weak prices, all of that has been a reason that the edible oil prices have continued to decline. Well, importantly, when you look at the Department of Food and Public Distribution, they have had a meeting with all the major oil associations, which is Solvent Extractor Association, SOPA and IVP as well, and they have all been told to tell their members that the earlier imported edible oil, which is at a tune of 30 lakh tons, should be sold at a lower level only. The new imported edible oil can be increased in sense of MRP. Until then, the oil companies and the FMCG companies will not actually get that windfall gain, pardon me, that markets were anticipating.
All right, Manisha, thank you very much for that. So that's a fair bit of action in commodities. We'll take a break. On the other side, our special segment is the economy. My colleague Lata will speak with Timothy Moore of Goldman Sachs to discuss the detail on the key FOMC rate cut decision due tonight. Stay tuned.